How many times has it happened that you expect the market to go up and you buy a call option? When the market starts moving in your direction, you make a pretty good profit. But the moment it comes back to the same level, you realize your position is already in a loss. You wait for some time and you see that the market is recovering again, but your premiums are not going up at all. You wait longer and eventually book the whole position in a loss. Or it might also happen as a seller, you might go far OTM and sell penny options suddenly to realize there is a big market move and the option which you have sold at 4 rupees has now become 40 rupees. In a panic mode, you go and square off all your positions again in a loss. So this is a regular occurrence which happens in the market. It is not because you're choosing the wrong strike, it is because you're not understanding how the premiums behave. So before continuing, I would also like to introduce First Stock. So we are a premium broking platform building premium products for trading F&O. In case if you haven't checked it out, open your account today by using the link in the description or simply going to signup.firststock.in. I am pretty sure this would be one of the best trading experience you have ever had. With that, let's quickly move on to the video. So as a beginner, people don't realize what they're actually paying for. When you take a look at the option can be broken down into two parts. One is the real value of option and the second one is the price you pay for the hope. Most option traders failed because they don't realize what they're actually paying the price for. When you take a look at an option, it comprises of two components. One is the real value of option and the second one is the price you pay for hope of a movement. So for example, if you are buying an option at 100 rupees, it can happen the real value of option can just be 20 rupees and you are going to pay additional 80 rupees as a hope that the market is going to move and you are going to be rewarded. So why should you pay for this hope? That is simply because the seller is going to take the additional risk of compensating you, or the seller is going to take the additional risk of taking a huge loss in case if the market starts moving. Because of this, he is going to demand some additional premium which the buyer has to pay. Professional option sellers mostly look for this. So what is the price of hope in the option and what is the expected market movement? If they see that the price of hope in the option is higher than the expected movement in the market, so then they are going to aggressively sell. Similarly, if they see that the price of hope in the market is much lower than the expected market movement, then they are going to refrain from selling options. Today, we are going to break this down all in this video and try to understand from the basics what exactly is the moneyness of option. For this, let's quickly get on to our first presentation slide. The prerequisite of this particular video is that you already understand how exactly call option and put option work. So once you have an understanding of that, so now you will be able to clearly relate to what we are speaking. So initially, let's start off with a call option side. So let's assume a stock is currently trading at 100 rupees. So that is the current market price of the stock, right? And let's assume a strike which is 90 rupees. So a 90 rupee call option. So whenever you take a look at the option chain, so there will be different call options. You might have call option at 90, call option at 95, call option at 100, 105 and so on. So these are the different strike prices. And let's assume you're considering a 90 rupee strike price. So now what is the current value of the stock or the underlying? It is 100 rupees. And your strike price is 90 rupees. In the market, if this is trading at a premium of 12 rupees, right? So the intrinsic value or the real value of the option. So intrinsic value is nothing but the real value of the option is going to be 10 rupees. Because if the expiry was supposed to happen right now, the option is going to end at 10 rupees. Because you have the right to buy at 90 rupees, you can sell it in the market at 100 rupees. That means the real value of option is going to be 10 rupees. Then what is the remaining? So the remaining is nothing but 2 rupees, which is the extrinsic value of the option or the hope. So this is what we call as the hope value. So this is what you're paying for the movement. This is what you're paying for the seller to compensate his additional risk. So in a 90 rupee call option, so you know that by default, the option is worth 10 rupees because you're taking a 90 rupee call option and the stock is trading at 100. That means you have the right to buy at 90 and you can sell it to in the market at 100, giving you a 10 rupee gain. So that is the intrinsic value of the option. Extrinsic value of the option is the remaining premium in the option, which is going to be 12 rupees. So now let's come to a different strike, which is a strike 100. So here stock is also trading at 100, strike is also trading at 100. So if you are actually going to buy at 100 rupees and sell it in the market at 100 rupees, you are not going to make any gain, right? So that means there is no point in exercising this option, because if you are anyways going to buy it at 100 and sell it in the market at 100, this option is going to be worthless. So that means if you are going to pay a premium of 7 rupees for this particular option, there is no intrinsic value. That means the real value of the option is 0, because it is not giving you back any money. So the real value is 0. If the real value is 0, whatever is the remaining premium, that is 7 rupees, is going to be the extrinsic value of the option. Extrinsic value is the premium that you're paying for the hope. So you're hoping that the market is at least going to move, or the particular asset is at least going to move 7 rupees from here to make any kind of profit. That is the difference between in the money and at the money. So this is called as at the money because market is also at 100. You are also looking at a 100 rupee call option. Then after at the money comes out of money, which is far from the market. So the market really has to move a bit for you to get any kind of reward. So these options will be priced low again. So when you take a look at it, let's say you might get it at 2 rupees or 3 rupees, so on. So these are the penny options, which are far from the market and they are going to price lower. So these options again don't have any intrinsic value, because if the underlying or the stock is available at 100, very likely you won't go and buy it in the market at 110. So that means the real value of this option is 0. Whatever is left out is your extrinsic value. So similarly, it works right in the opposite direction for put, right? So in put option, you have the right to sell, not the right to buy. For example, if the stock is at 100 and you are looking at 110p, right? So that means you have the right to sell at 110 and buy it back at 100 rupees. That means straight out you will be making a gain of 10 rupees. So here, when you take a look at it, so these are called as in the money put option because they're already having some kind of a value. So the real value of this option again is going to be 10 rupees, which is the intrinsic value, and whatever is the remaining premium is going to be the extrinsic value or the value for hope. So similarly, the ATM strike remains the same because market is at 100 and even your put strike is at 100. So if you're paying a premium of 7 rupees, then here no intrinsic value because it doesn't make sense for you to exercise this option. The extrinsic value is whatever is the remaining premium, which is 7 rupees. And similarly, a 90 rupee option, in this case, what will end up happening is you're paying a 2 rupee premium, and since it is already 10 points away from the current market price, whatever is left out is just going to be the value of hope. So broadly, when you take a look at it, so you are paying two values. One is the real value of option and second one is the value of hope. So when you take a look at this particular extrinsic value keeps on changing based on the volatility in the market. If the market is extremely volatile, then these values will be higher because the seller is going to come and say, if the market is very volatile, then I have a higher risk, because if the market starts to move up from 100 rupees, then for every rupee it is going to go up, I have to give you a certain amount of compensation. This can be clearly visualized using a option strategy builder. So I'm going to open a strategy builder on first stock option chain. So let's say I simply end up setting a call option. So I'll save this strategy. So we can see in the strategy builder, as and when the market starts moving up from here, so the seller will actually start losing money. If it moves much higher, he does not have any cap on his loss. So he's only going to make money if the market stays there or it is going to come down. But if he's selling a call option, he's going to lose money as and when the market starts to move higher. So because he is taking this risk of unlimited loss with a limited gain, right? So he is going to demand some additional premium. And this additional premium, what he is going to demand is nothing but the value of hope. This is also known as the value that you pay for the market volatility. If the market is extremely volatile, then this value is also going to be much higher. And if the market is less volatile, then the additional premium what you pay is, that is, the extrinsic value is also going to be lower. So this way, based on how the volatility is, so people are going to price the options in the market. So I hope this is as of now clear that how exactly option pricing is done. So there is one real value of option. It does not change based on volatility. It does not change based on time left to expiry. It does not change based on any factor. But there is the extrinsic value of options, which is actually going to change based on the volatility, based on time left to expiry, and multiple other factors. So this value is influenced by external factors. This is not going to be influenced by any particular value. So now, again, one very important thing is for you to know this formula. Intrinsic value is nothing but the option premium minus extrinsic value. So that is basically whatever is your premium of the option minus your extrinsic value is going to be your intrinsic value. So that is the real value of option. So let's try to take an example. So an ITM option or in the money option is something which is also having an intrinsic value and an extrinsic value. So in this case, this is going to be an ITM option. So we call it in the money because it is by default having a intrinsic value. So that's the reason it is called as a in the money option. So if we were to take a look at the option chain, so this is Sensex. Today we are having Sensex expiry, and currently the market is trading at 85,501. So that means if you take a look at it, any option below 85,500. So 85,500 is going to be at the money because that is where the market is. Any option below 85,500 is actually going to be an in the money option because it is going to have both the intrinsic value and an extrinsic value. So in this case, 85,400 option will be having almost close to around 100 rupees of intrinsic value, 34 rupees of extrinsic value. Similarly, 85,300 is going to have a 300 rupee intrinsic value and 20 rupee extrinsic value because it is trading at 222. Right? So this way you can take a look at it, how exactly ITM options are going to be priced. So they are going to have both intrinsic value as well as extrinsic value. So again, it comes with the idea that you already know how exactly a call option works. So you already know about right to buy and not an obligation to buy. So at 85,300, you have the right to buy at 85,300 and sell at the current market price, which is 85,500. So whatever is the value of that option is going to deliver is the intrinsic value. In this case, it is going to be 200. Next, we have the ATM options. So ATM options, they have no intrinsic value and whatever is left is the extrinsic value. And then we have the OTM options, which are far away from the market. Again, they have no intrinsic value. They only have the extrinsic value. So you can see these options, which are ATM and OTM. So if we were to observe the same thing in the real option chain, so right now the ATM is 85,500 because that is where the market is and they are quoting 70 rupees. So if you expect the market to move more than 70 rupees on the higher end, you can pay this to the seller and you can buy this option. And then as the seller starts assuming lower and lower risk. So for example, for this he is asking 70 rupees. But if you tell, okay, you can give me a compensation only above 85,600, then he is only going to ask you 28 rupees because his risk has now been reduced. So similarly, if you tell, okay, give me a compensation only above 85,700, which is after a 200-point move, his risk has now further come down. So he's only going to charge you 10 rupees. Similarly, as you start going higher and higher, so if you tell that you only compensate me beyond 85,900, now his risk has further come down. So what he is going to do? He's simply going to tell, okay, pay me just 3 rupees because my risk is very low because from here market has to move another 400 points within the span of next few hours for me to even give you any kind of compensation. Since my risk is low, I am okay to collect lower premium from you. Hence, you just give me a premium of 3 rupees. So again here, as it is, the option does not have any value. All these are OTM options and you are just betting on the hope that market is actually going to move. So now is the most important part of this video. As a buyer or as a seller, what should you really trade? So should you trade ITM options? Should you trade ATM options or OTM options? So let us try to break this down. So let's say you're an option seller and you take a look at this, that this option is trading at a premium of 12 rupees. But the issue of selling this at 12 rupees is, as a seller, you're only going to receive the value of hope, which is 2 rupees. You're only going to receive 2 rupees for the risk that you're taking. So now let's say you're a seller and you end up selling this option. So this option by default has a value of 10 rupees. That means no matter what, if expiry is going to happen right now, it is going to end at 10 rupees. So that means the compensation you're getting for taking the risk is just 2 rupees. So you're only going to get 2 rupees to take on the entire risk. So by any chance, if the market starts to move against you, so you don't have enough premium to compensate your risk. So what will end up happening? So you will actually end up losing money at a much faster rate. So if you are not sure of market coming down, or if you just feel that, okay, market might consolidate here or there might be a small up move, which I'm not really concerned about, then as a seller, this is not the option you should be touching. That means we only have two options left, which is a ATM or a OTM. That means which one should I sell? Should I sell this particular ATM option or the OTM option? So this depends on what is your judgment about the market. So when you take a look at this, if you feel, okay, I am getting a total premium of 7 rupees, but I feel the market is not going to be so volatile. So then this is a perfect option for you to choose because your expected volatility is much lesser than what the market is pricing in. So if you don't expect it to be so volatile, then this is a perfect option for you to choose because this has the highest extrinsic value. So wherever there is a highest extrinsic value, that means you are going to be compensated the most if the market is not going to move anywhere. So when can you choose OTM over ATM? So you expect, okay, market is here, but it can be slightly volatile. What if it goes to 105, 106 or 107? What if the volatility is pretty big? This can be a challenge now. So to get out of this challenge, you end up going far away and collect just 3 rupees because you expect the market to be volatile and markets to come towards 107, 106, 105 anytime soon. So if you feel the volatility in the market is expected to be higher, then you go for OTMs. If you expect the volatility in the market to be lower, you go towards ITM and collect higher extrinsic value. Here you are only collecting 3 rupees of extrinsic value. Here you will be collecting nearly close to around 7 rupees of extrinsic value, right? So it is always better to go for 7 over 3 if you expect the volatility to be lower. So here you are collecting the same premium. So here you have collected 2 rupees, here you have collected 3 rupees, but the only difference is going to be that here you can wait till the market actually goes to 110 before you start compensating the option buyer. So that means as a seller, mostly you can go for these two options depending on what is the expected volatility and what premium the market is giving you. And similarly, if you expect a directional move, it is better to buy. But if you are expecting a fall in the market, then you can also end up selling ITM options because if the market is going to fall, it is going to give up the entire intrinsic value also. So now let's come to a real market, take a real example and see how things work. So for example, today is the expiry day and the time is already 1 o'clock. That means we only have another 2.5 hours for trading. So currently the market is at 85,500. So let's round it up to 85,500. And this 85,500 call option is now trading at a premium of 70 rupees. If you feel that the market is going to stay around 85,500, right? So do you think 70 rupees as a compensation is going to be sufficient for you? So let us see if I were to sell at 85,500, where my break even is going to be. So I'll just create a basket. I'll sell a 85,500 option. So you can see my break even is going to come at 85,565. So is this 65 premium sufficient for you? Are you expecting a 100, 200 point move towards the end of the day? So this is a question that you have to ask yourself as a option seller. If you expect 200 point move, then you can simply go and sell this at 10 rupees rather than selling this at 67 rupees. So even though your maximum profit is going to be lower, so you can see here you are making 1300 rupees. But if you come and sell something like 85,700, you're just going to make 200 rupees, 5 times lesser. But your profit probability is about to shoot up. First of all, now you have enough room because you're 200 points away from the market. So even though the market is little volatile, it is not going to expire in the money, or options might expire out of money also. So that's the reason you have a higher probability of making a profit. But so this is what the market is offering you. But what do you think? Is it going to be so volatile? Can you take higher risk? If you can take higher risk, you can come to 85,600. If you can take higher risk than that, you can come to 85,500. So this is the place where you're going to get your highest extrinsic value, or place to make the highest profit. Now we are going to explore the same thing from the perspective of a buyer. So as a buyer, your choice of the strike is going to depend on the quantum of move you're expecting. So this is the one and the only important thing, the quantum of move, right? So if, or you can again term it back as volatility. So how much or how quick you're expecting the move to be, and how volatile you're expecting the move to be. So if you're expecting market to slightly and slowly and gradually go up, then your choice should always be a ITM option. So why should it be a ITM option? Simply because your ITM option by default has a real value of 10 rupees, has a extrinsic value of just 2 rupees, and as and when the market slowly starts going up, this extrinsic value is very quickly going to get covered and it will start rewarding you. Second one is, if you expect sudden quick moves, then you can go either for ATM or ITM. Again, it depends on two things. If you are expecting the volatility to shoot up quite a lot, then these ATM options can be one of your choice, unless you're expecting something like a jackpot trade. So now let's say you take a look at this option chain. You see an option like 85,600 or 85,700. You see that, okay, market is just pricing in at 9 rupees. But you expect post 2 o'clock, anyways, just 2.5 hours left. Post 2 o'clock, you are expecting a good 200 points move, which is just 0.2%. You feel that it is highly possible because market has not moved from the morning, and this move can very easily come. So in that case, you feel that just 9 rupees is a pretty cheap price to pay. So market is not really pricing in the volatility right. In such cases, you want a jackpot trade from the 85,700. If it actually ends up going to 85,700, this option is going to quickly surge towards 20 rupees or 30 rupees or even 50 rupees. So you can book at 50 rupees and get out of the trade. But on the other hand, you feel, okay, markets can be volatile, might not actually be to an extent I expect. So in such cases, this can not be a worthwhile option. So you're not really looking for the jackpot trade. So what you're actually looking for is this thing where you expect. So there might be slightly lesser volatility. So I want to play this volatility. I expect markets to try to recover towards 85,500, 85,600. So this is what your expectation is. So then you go with options like 85,500 or 400, slightly in the money. But one important catch is, when you are expecting it to go to 85,500 or 600, it should happen immediately. If it is happening at 3 o'clock, if it is happening at 3:15, then there is no use. You are actually going to lose money. For it to happen, it has to happen immediately. Only then you're actually going to make money, right? So if such is your expectation, where you're expecting a quick up move and you're not expecting the volatility to be too much, then ATMs are the ones to go. And finally, now you expect, okay, markets can hit towards 85,600, but I'm not sure, or even 85,700, but I'm not sure if it is going to happen immediately after 1 hour, after 1.5 hours, but I expect some kind of up move to come towards the end. So then your pick or your option choice as a buyer should be ITM options. So let's simply go with this example, 85,300. So you can see that your break even is going to come at 85,507, right? Almost where the market is at. And anything it starts to go above this, you're actually going to end up making a smaller gain. So this way, depending on what is your expectation from the market, don't just look at, okay, I am expecting the market to go up, I'll buy an option. I'm expecting the market to come down, I'll buy a put option or sell a call option. So you should also expect what is the premium that the market is giving. Is it worth taking this premium and trading or not? So these two are something really important, which a lot of traders actually miss out. So they just take what is given in the market. So obviously that is what you should do. So you can't demand what you want. You take the price given in the market, but you should have an idea whether it's cheap or not. So when you go into the market to buy, let's say, a tomato, or let's say you go into a vegetable market to buy groceries. So the prices of tomato, prices of onion, prices of other vegetables also keep moving up and down. But you will have an idea whether today carrot is cheap or expensive. Today onion is cheap or expensive. Today tomato is cheap or expensive. If it is cheap, generally you end up buying more. If it is expensive, then you generally buy less quantity of it. So you should have an understanding of what exactly it is. So if it is high, as an option seller, you can also end up selling more quantity of it, right? So this is a simple example or simple metaphor of how you can consider options as how. So to again summarize the entire video, so an option generally consists of two values. One is the real value, which is the intrinsic value. Second one is the extrinsic value, which is the premium that you pay for the seller. So this premium is dependent on multiple external factors such as volatility, time left to expiry, interest rates, so on. So a lot of different factors which are going to influence this particular value of premium. As an option buyer or as an option seller, your choice is to assess the volatility in the market, see what is the price that you are paying. Is it worth the price? Is it worth selling at this price? Is it going to reward you enough? Or as an option buyer, what is the extrinsic value you're paying, or what is the value of hope you're paying? Can the market actually move? If the market is actually going to move so much, which is the right option I should be choosing? So is it OTMs, ATMs or ITMs? Which one should I choose? What is the expected move I have out of the market? How can I benefit the most out of this? So these are some of the questions which you should ask yourself before entering into any trade. So it is very easy to simply pick an option, enter a trade randomly without having a clear plan or clear idea. What I want you to do is from next time, ensure that you have a clear idea in mind. Try to see how the market is moving generally. You open a 5-minute chart, 10-minute chart, 20-minute chart. As a seller, you see, is it pricing your risk well? If yes, then you can sell it. If no, then you can wait for it. As a buyer, you're going to consider, is it cheap today or expensive today? How do you know it's cheap or expensive? It is simply based on the volatility in the market. If the volatility is high, but option price is low, then you know it's cheap. If the volatility is low, option price is high, then you know it is expensive. So this is one simple rule of thumb that you should follow in the market. So I hope this video was informative and interesting. So this is a beginner level video where I want to teach you option trading, where I want to introduce you to premium way of trading with First Stock. So in case if you haven't opened your account, click on the link in the description, and also don't forget to hit the like button, subscribe to the channel because we will be coming with more such videos soon. Thank you so much for joining guys, and see you soon in the next video.